Okay, everybody. Firstly, thank you all so much for attending the Planet MicroCap Showcase Vancouver. We absolutely love it up here, and we're just very, very thankful for all of you being here throughout the day and engaging with all of the amazing presentations and keynotes. And we got a really fun one here to close out our day of company presentations and keynotes. So our final panel today is a panel titled Capital Resilience, Finding Alternative Routes to Capital in Today's Markets. Moderating today's panel will be Serin from the CSE, and our panelists, as you see up here, Alixe Cormick from Venture Law Corporation, as well as Marc Branson from CapWest Investments. So, Anna, the floor is yours.
Thank you very much, Bobby. So firstly, I love that they put me right before the wine. So you're either all really excited about this conversation or excited about the wine. Either way, thank you so much for doing such a long day of presentations and joining us. My name is Serin. I'm Director of Listings Development with the Canadian Securities Exchange. Thank you so much to the Craft family for putting these events on, especially in these markets, which is what we're going to dive into, is the complexity of raising capital. If any of you have looked at your portfolio today, you'll know exactly what I'm talking about. There are alternative routes, especially in the junior space, and there's ways to maneuver around those. So I'm lucky to be joined today by Alixe, who is a securities lawyer based out of Vancouver, and Marc Branson, who is director, CEO, financer, promoter, dare I say. So we'll cover, a bunch of different venues that we can go through the markets in these times. I think one thing that's really important to start with is to cover what markets we're seeing. So maybe first I'll start with you, Alixe, if you don't mind. You can just tell us a little bit about yourself and why you're joining us up here on stage, and then maybe just give us your synopsis of what's happening in the markets.
Okay, my name is Alixe Cormick, as I said before. I'm a director of the Private Capital Market Association of Canada, a legal advisor to the National Crowdfunding and FinTech Association. I'm on the Commercialization Advisory Board at the Life Science Institute at UBC, and I'm a corporate securities lawyer. My area tends to be more tech and biotech than mining, and a lot of the companies that we're seeing right across the board are struggling. So it's not just you, it's the markets in general. So BC Securities Commission put out their annual capital raising report on August 17th. It's available on their website. And you'll notice that for companies, not including investment funds, for issuers raising capital in British Columbia, it's down 47% in 2022. And the market's still kind of hitting a lot of headwinds in the negative sense in 2023.
Thank you, Alixe. Marc, tell us a little bit about yourself and what you see is happening in the markets today.
Sure. Thanks, Anna. My name is Marc Branson, and CapWest Investments is my company. And I've been involved in small, private, and public companies for over 30 years now, funding them, developing them, marketing them, and hopefully selling them. And look, we all know how difficult it's been lately, but this particular downturn is being long and protruded, and that's what's making this one a little different. So as we go look for money, and as we ultimately seek the lifeblood of the juniors, which is the capital and the raising it, it's very, very tough because the windows are getting small, and the ability to compete and stand apart from all the other competitors while you're raising money has become a challenge. And it's really, really important for investors like yourselves or companies to find a way to connect that's meaningful and actually allows both the company to grow and the investor to grow with it. And I think, it's over the next kind of half an hour, we'll talk to some of the different ways that companies can engage with investors and some of the positives that the investors can find in these rough markets, right?
Thank you. One question I have for you guys is a bit of a multi-prong here, is that obviously there's a bunch of catalysts that have brought us here. And the junior markets always seem to get hit the hardest and probably the fastest when we have these big catalysts. Do you think that this downturn is unique, or is it part of the course and just stay the action like we have in the past? Or do you think there's some different elements to what we're going through today?
Usually we have at least one sunny area in the world that we can go to. But if you look across the capital markets in the Western world, Australia, their interest rate is holding. So that was Tuesday, they decided to hold it at 4.1. Canada, of course, we held today at 5.0. UK's 5.25, but they're threatening to move it up to 5.5 next month. And then the US is, I don't know where that's coming from. And then in the U.S., we have, of course, it's sitting at 5.25 as well, the interest rates. And part of the issue is that we're not getting any love anywhere right now. Europe is hurting as well. China's definitely hurting. Country Gardens, of course, made its payment, but its government stepped in to make sure that happened. So that was kind of a saving grace, but then their PMI wasn't very good. And we look at all those different factors. The VIX has always been a factor. And then, of course, September, October's never been great. So it's been, as Marc said, contracted, and it's a bit of a concern as to where do you go. There are some lights, but as Marc said, those windows open and shut really quickly, and if you're not prepared, you're going to miss the window.
Okay, Marc, for you, the question is coming from the issuer standpoint. Obviously, as a company continues on in these markets, there's general costs associated with the company. There's growth costs. If you're doing your exploration, you're going to have to do at least a compliance or work program. How does a company manage this in these types of markets?
You know, it's very cautiously. You know what? Venture companies generally, especially the ones pre-revenue, they rely on consistent capital raising at a reasonable valuation for their growth and their sustainability. So the first thing the companies have to do is they have to make sure they're good stewards for the capital. They have to reduce their spending wherever possible. And then they have to communicate to the shareholders and the stakeholders exactly what they're doing, why they're doing it, how they're doing it. Clear and effective communication is the only way through the bottom of the market. It's kind of a double-edged sword because although it's difficult that is to actually tell your shareholders, hey guys, we're in jeopardy, this is scary, these are things we need to do, we need to cut costs here, and we're worried about this. It also strengthens the bond with the stakeholders and the shareholders. And if they actually do come back in and continue to fund you, it also allows them the ability to grow with you. So I'd say that's probably the number one thing an issuer can do is really increase the communication and make sure they're honest with themselves and the stakeholders.
One question I have for you as far as, I mean, obviously we're dealing with these markets, but also I wonder if we're dealing with a different type of investor and how you manage that. We used to have investors that would manage these waters through their professionals, their brokers, their investment advisors. We have a lot more unsophisticated investors coming to the market that are educating themselves, that are utilizing available information on their phones, and they're trading for free. Is that affecting relationships with investors as you move through this?
Well, I think that just goes to speak to the flatiness of capital or the speed in which capital changes. You know, and I'll let Alixe speak to some of the details in that because she's obviously a securities lawyer, kind of understands the ins and outs of what the industry is trying to do as far as protect investors and help the industry have like a healthy integrity in that process. But you're 100% right. Without the retail broker or some sort of institutional professional being the gatekeeper for investors, it's kind of a natural occurrence for them to sell at the bottom and buy at the top. And that is something that, again, the only way through is communication, whether it be effective IR, whether it be just presenting. But you're right. It is a real issue that some of the less informed people are making decisions, contrary to the best interest, really, is the best way to put it, right?
You know what I love about these forums is I think this has become a time more important than ever, especially after the pandemic, being locked away in our homes for us to be in these rooms. There was a moment where, before information was so easily accessible to us as investors and as issuers, that maybe this was something of the past. But I think more than ever, and I don't know if you agree with this, forums like this where everyone's in a room together having these conversations and dialogue are probably one of the most important elements of markets like this. Wouldn't you say, Alixe?
Well, first of all, let me back up a little bit. I've actually done 8 broker-dealers across Canada, 2 of them discount broker-dealers. One of the second, I guess, in line for discount broker-dealers for a large banking institution. I don't necessarily agree that that is the problem. There are problems in terms of the rules, in terms of concentration and risk profile. So part of the issue is for someone that's over 60, brokers have an obligation to say your risk profile is now different than someone in your 20s. You can't afford to lose money. So riskier early stage companies, whether they're private or public, should only make 10% or less of what your market portfolio looks like. And also concentration just in one area. So if I want to go all mining or all tech, I'm going to get feedback from the broker saying you can't do that because you need a balanced portfolio. What does that look like? And I think those have more of an implication than anything else.
And those are fairly new to the Know Your Client rules, right? That's kind of in the past 20 years?
Well, it depends what you think is new. 20 years versus, 100 years. Maybe that's the new. But we've had I've been around for a long time, so I became a securities lawyer back in 1992. So I've seen quite a few different market cycles as we've gone in and out. But certainly in the earlier days, you would have kind of longer windows. You would have more small broker dealers. At one time, we've had a contraction like no one's business in terms of all of the little small boutique firms that used to exist across Western Canada have pretty much been absorbed, and everyone's become risk adverse. So we now have, a more kind of a view towards portfolio management rather than actually saying the client tells me that they want to sign a form saying they're fine with concentration. I've had several clients tell me that they can't buy the stock they want because their broker says it's too much a risk for them. Yeah. And then they want to go to a discount broker, but then they find out they've got collars on as well.
Yeah. Yeah. I mean, that definitely is a push. I got my broker's license in 2012, and that was the mandate, move everyone to manage money, and we spend all of our money on compliance. So there definitely is a shift there. I think, one thing I'd like to get into, because obviously that is a more traditional format of portfolio and asset allocation and investing type. But let's talk about the junior markets, because there's obviously a lot of unique ways and alternative ways that we can manage these waters. We don't see them as often when the markets are really good, because just a straight capital raise, IPO, shelf prospectus is easy and easy to raise capital. Probably the most recent one that we experienced was the cannabis space from 2017 to 2019, maybe. They could print money. It was pretty spectacular to watch that occur. Now, as we enter these markets, there's a bunch of alternative routes. So, Alixe, I'm going to start off with you. Maybe we could talk about a few of those different options. We'll talk about Canada first, some of the exemptions that exist, and maybe you could speak to them. We've just seen the life exemption come to market. I think we're starting to see a bit of a pickup of it, not a ton. Maybe you could just give us a little bit of the high level of what the life exemption is, because I'm assuming most of you have at least heard the name life exemption.
Well, let's again talk about the fact that we have the rights offering. So the rights offering, the existing issue or existing investor exemption.
Yes, we have a list of them that we can go through. Do you want to go through all of them?
And the investment. Well, they're all kind of related. So
okay.
It's kind of like we had the rights offering. It didn't really work for people. People said it was too complicated, so they kind of streamlined it a a bit, and they didn't get the pickup.
In theory, it was a good offering, though, wasn't it? Because it allowed existing.
I think part of a lot of these exemptions is people don't know that they exist. So 85% of the capital raise last year was done under the accredited investor exemption, and then everything else kind of followed. And so really we had, about $1.5 billion that was raised outside, so 72,503 outside of British Columbia. We had the offering memorandum exemption, again about the same amount, and then the minimum investment. Those are the ones that tend to be the primary. The life exemption came about in November of 2022, so it's relatively new. We have the existing issuer exemption, and then tied with that is the investment dealer exemption. You have kind of, again, it's kind of a bit of a waterfall approach in terms of what do you want to do. If you're in trouble, really reach out to your existing base. As long as you've established those relationships and communicate. Anna and I were talking the other day, and it's kind of like going to your dad. The only time you want to talk to him is when you need money. Your dad just, every time he calls, says, "What do you want, kid?" Because that's all you ever call him for, rather than saying, "Hey, Dad, let's go for a walk. Hey, let's do stuff together, and you're a fun guy." right? So don't call just when you want something. Keep the communication going and keep people informed. So when they do call, they know what's going on with your company and they either like it or don't like it. And sometimes they may even help you out, sort of thing. But the rights offering exemption allows you to raise at lower than what the market price is. It allows you to raise up to 100% of what your issued and outstanding is. The existing securities exemption tied with the investment dealer, they have kind of a different kind of requirement. So usually the rights offering is pro rata. The existing security and the investment dealer are pretty much two sides. One is your existing security holders. The other one is people that you can reach through an investment dealer. You have to drive them through an investment dealer to get them. But you can do those offerings together, tie them together, and it allows an investor to invest $15,000 unless they get suitability advice if they're an existing investor, and then they can invest more depending on the suitability. So the investment dealer, if it's a new investor, it's a $15,000 cap. So you go up kind of to the next level to Life. Life has larger caps for investors, but only allows you to raise up to 50% of your market or your issued and outstanding shares over the last 12 months, whatever is the lowest during that 12-month period prior to your notice. And, or I should say 10% of your total issued market cap. And
it's got a lot of boundaries around the life exemption, right? You have to be listed issuer for a certain amount of time.
Yeah, so the problem with the life exemption really is that you do have to be listed for 12 months prior to using it. You do have to raise enough capital or have enough capital in hand for 12 months. You can't have done an acquisition or a reorg transaction in 12 months beforehand or use the money that you're going to raise for that purpose. And so it really kind of restricts kind of who can use that exemption. There's a little bit less around those other two that we talked about in terms of what you can do. But those exemptions, if you use them properly, are a way to kind of bring your existing kind of crowd in and kind of introduce them. The life exemption, there is no exemption from the registration as a dealer, but 31103 does have kind of what they call the business trigger rule, which you can really kind of leverage that if you want to.
And Marc, I want to ask you about that. Well, I'd like your advice on how you feel as an issuer about all of those exemptions. But the other thing that the life exemption does offer is the no 4-month hold period.
Yeah, so look, I'm really happy that the regulators and everybody's trying their best to create avenues for raising money. It's really important to do so, and they're addressing some of the kind of long-term structural issues that we have in the marketplace. But as an issuer and you're raising money, a lot of these things have their drawbacks as well. Like a rights offering is really, you don't really want to do a rights offering unless you're really, really in trouble. And you still really need a lead order for somebody to clean up your rights. So it has its own complications. The existing shareholder one, that's kind of tough. If you're going through a brokerage firm, a lot of those guys just don't like doing it. They don't like the risk. The life exemption is probably one of the best exemptions that come along in a long time, in my opinion. But it also has some drawbacks too, because now they're really focused on your market. Because it's priced at market, and now like how liquid is your market? What does it look like? So how active your market is kind of going to determine how much money you're going to raise and what it feels like, and then what happens right after you sell that stock because it's free trading. What's the market going to look like in a week, in a month? So all of a sudden it's something else now you have to deal with as a public company as you kind of go through it. The old school accredited investor, and there's probably a reason why 85% of the money raised that way. It's really nice for an issuer. You raise the money, you got 4 months, it's not back in your face. There's usually a warrant sweetener with some sort of reason for them to write checks in the future if the stock's doing well. So although these are really great, and I'm really glad everybody's done it and focused on it, they're just mechanical ways to accomplish things. They don't change the fact that the company still needs to be active, still needs to have a liquid market, and it still needs to communicate. But in my opinion, I'm really, really, really happy that everybody's trying, right?
Okay, so on that note, as far as what options there are in Canada, I think the thing with these exemptions is they're complicated, right? And like you said, at the end of the day, there's some basic points that an issuer needs to have, whatever exemption they choose. Most of it has to do with having a relationship with your existing shareholder base. So that seems to be one of the fundamental parts of it. Let's talk about leaving Canada. What do you think there is as far as opportunities with either Reg A Plus in the U.S., as a Canadian issuer and even on a global platform?
Sure. So I'm going through my very first Reg A Plus right now. So we'll see how it transpires.
To be determined.
Yeah, to be determined. But you know, I like the fact that we can raise up to $75 million. I like the fact that you're allowed to market the offering. So far, it's been fairly painless. The process. The hardest thing that we've actually had to go through was the U.S. audit. For some reason, it just didn't transpire, even though it was the same Canadian firm to the same U.S. firm. We pretty much had to re-audit the thing. So there are some obviously complications there that people are going to face. But the ability to market it, an offering, it's going to be interesting. It's going to be interesting. You know, I have heard some success stories. We're working with a group, Delmore, out in New York, and they've told us quite a few success stories. And so it'll be interesting to see how it all unfolds.
Well, I remember it was not that long ago that they kind of opened up the Reg A Plus and made it a little bit easier and opened up the amount. And I know that there was a lot of apprehension around it, but from my understanding, it's and I think there's a lot of you from the U.S. here today, but it's heavily utilized in the U.S., isn't it? Alixe, what's your thoughts on Reg A Plus?
So both their CF, like their crowdfunding, the federal level, as well as the Reg A, and even the credit investor exemption, where it is more like a shout out to the world, is very heavily utilized in the U.S. I've done 8 Reg A offerings. Only one did not close out of those, and they were all successful. We did one with a Canadian issuer that was listed on the CSE. That was about 4 years ago, I think, maybe 5 years ago now. And the CSE worked with us in terms of making and accommodating kind of where that was. The upside of that, you know, as a reporting issuer, that issuer was trading at around 20 cents, 15 cents before they started. They were trading at 85 and went over to $1.35 before they closed. And so part of it is that it gives you market recognition as well, because you are able to test the waters. And so one of the things you have to understand, here in British Columbia, we have 72503. 72503 accommodates a Reg A offering. It essentially says qualification and testing the waters okay. And it says that those securities, if you are a reporting issuer here in Canada and have qualified a Reg A offering in the United States, that stock is free trading, as long as you're not intentionally selling it back to a Canadian. And so there's no legend that goes on there. There's no requirement to file a 45106 F1, but there is a requirement to file the Reg A document and anything that was filed in the United States.
So, Marc, in these markets, would you turn to the U.S. or outside Canadian borders with the way the capital is here?
Absolutely. You know, it's the U.S. It's an interesting beast. You know, at 80% of our volume and financing really comes from the U.S. It really does, and they don't really have that strong of a public junior market. They have a very strong VC market, lots of really smart people, obviously, but their actual small cap public company space. Just the way the OTC kind of blossomed, it didn't lend itself to a real exchange like the venture or the CSE. So there's a huge opportunity for Canadian listed companies to go down in the States, work with Americans, and build out a shareholder base and really capture that investment. Even companies in the States. In fact, quite often when I'm down in the States talking with companies and they're looking to move forward and they have the option of getting listed or maybe a VC, you know, quite frankly, they end up coming to the Canadian markets for our junior markets and then come back and then raise money back in the States if they choose not to go the VC route, which is very interesting. It's a unique scenario. I'm sure one day that circle will get squared, so to speak. But as it exists now, it's very much an opportunity for Canadian companies to go down there and raise money, and an opportunity for U.S. companies to get listed up here and cross-border trade.
Thank you. I want to ask you just some closing remarks, but before I do that, because I want to be conscious of time and when the bar opens, does anyone have any questions before I? Yes, sir. The question was, what's the difference between the Vancouver, the AIM, and so the Vancouver exchange no longer exists. So that was taken over by the TMX group, so it's now called the Venture Exchange. The AIM exchange is based out of London, and the Australian exchange. That's a pretty loaded question. I'm not sure, Alixe, did you want to?
I've listed companies on the LSE. I've listed them on AIM. I've listed them on the New York Stock Exchange, NASDAQ, TSX Venture Exchange. Haven't done anything on NEO yet. Euronext, basically NASDAQ's kind of Euro exchange. and I've also listed on the Hong Kong Stock Exchange. I'm agnostic, guys. I go where the love is. So I always say, look where your peers are. Look who's going to give you the best valuation. Some of it's determined by size. I don't want to kind of diss anyone, but AIM, generally speaking, companies that have listed on AIM, your capital raise can be good, but secondary capital raises are difficult, and there's not that much liquidity. So people find themselves in trouble pretty quick there. LSE is a little bit different, but again, it depends on how big you are. And I did fairly large financings at one time. Like this morning when they were talking about the CBOE exchange, I've done ADRs, I've done GDRs. The CDRs that they're talking about is kind of like a made up, Canadian depository receipt sort of thing. Haven't done any of those, but I've done the other two. The difference is you're always looking for liquidity, right? You're looking where is the love. NASDAQ, New York Stock Exchange market, why you would list on one versus the other is one has more biotech or tech or mining or other sectors. You want to be where your peers are because you're going to have more eyeballs. It's kind of like, you want to be on the shelf where all the apples are if you're looking to be bought as an apple versus being in the section where it's raw meat and you're the only apple sitting there. No one's coming to look for you there. You want to be in the section where people are going to show you the love.
Thank you, Alixe. Marc, did you have any comments on that?
I just want to kind of touch on that actually. Well, congratulations on the Hong Kong listing. That's really difficult, by the way. Australia is a really interesting one, especially when it comes to mining. And I'm kind of glad somebody brought it up because the arbitrage of valuations is interesting. Their valuations and their market caps are way higher than ours over here. Not really too sure why, and there are some theories, and you can really get into it. But it's interesting when you talk about exchanges in different countries, and we were talking about the U.S. and Canada and some of the logistics there. But Australia is one right now where it's kind of a bright star. Their valuations, especially for some of the battery tech stuff, is off the charts.
They've rocked a retail market, especially in the resource space. Yeah, absolutely.
And their mining reports are different, right?
Yeah.
And the type of disclosure you're doing is different.
It flows in their blood. I mean, I've been over there now, and I'd say it's very sister-like capital markets to Canada and North America. But anyway, they've upped their qualification to listing, so they're kind of leaving the junior space, or they're attempting to leave the junior space, I believe. Any other questions? Okay, so I think I have 2 minutes left, Shelley. I'll wrap this up quickly. What I wanted to ask you guys as kind of a final comment from each of you is, although we've done a little bit of doom and gloom conversation around the markets and the difficulties in raising capital, maybe you could each just touch on a conclusion of where opportunities may lie for companies or investors, to invest or raise capital in these markets.
Yeah, and I think maybe just echoing some of the statements we made earlier, and the opportunity really exists in building a very strong relationship with your shareholders and your stakeholders in difficult times. The shareholders, if they have the capital and they're still there and still behind you, they're the best source of new capital because it allows them to average down and continue to build that relationship. But it also allows them for the upside because, we're all assuming that these markets won't stay rough like this forever. And when they do turn, you want to be involved and you want to be invested and you want to be part of the company. So I'd say the opportunity is for the investors to stay with it. And the opportunity is for the company to build stronger relationships with the stakeholders and those around them.
That's something we talked about a lot actually in our pre-chat, and I think that's really important to preface is that the markets, especially the junior markets, they can turn on a dime. And so you certainly want to be ready when that happens. So you want to have good relationships, as you were saying, Marc. As an issuer, you want to be ready for that day to happen. You don't want to be playing catch up because you'll already be behind if that's the case, right? Alixe, what are your thoughts?
Well, again, it's kind of in anything in life. Oftentimes, even though there's kind of like dark corners everywhere, there's always bright stars. One of our clients, which is a private issuer, just raised $4.8 million out of $8.5 million that they were planning on doing. They opened up their offering about a week and a half ago, and that's where they are today. They're now going to use an exempt market dealer to help them raise the remainder of it, and we'll see how they go with it. So, there is still money out there.
There's still companies raising money.
That's right.
Yeah.
That's right. Sorry. and why not you, right? Like, why not you? Part of it is being ready, making sure that you are ready when you meet the right person and the window is right.
Wonderful. If there's no more questions, I think we could probably keep going into the night, but we will stop for the bar to open. Any other questions? Thank you again, Shelley, and to everyone for letting us join on stage. Thank you.